Have you ever stopped and wondered what really happens on the stock market after that 4 o'clock closing bell rings? Well, today, we're going to pull back the curtain on after-hours trading. It's this whole other world of opportunity, but as you'll see, it's also packed with some hidden risks. Let's get right into it.
Okay, picture this. You've closed your laptop, the market's gone quiet for the day, and then, bam, some massive game-changing news drops. Maybe a huge earnings report or a surprise merger announcement. So are you just stuck? Do you have to sit there and wait until tomorrow morning to make a move? Well, not necessarily. And this is exactly where after-hours trading enters the picture.
So how does this all even work? We're about to break it down. We'll start with the opportunity, trading beyond the bell. Then we'll look under the hood at the after-hours machine itself. We're also going to explore why this marketplace is so quiet, what that critical price gap is all about, and then finally we'll weigh the big question, risk versus reward. All right, first things first, let's talk about the why. I mean, what's the big appeal of trading after dark anyway? It really all comes down to this window of opportunity that, honestly, most investors don't even know is there.
You see, the trading day is actually way longer than that 9:30 to 4 o'clock window we're also used to. Before the market even opens, you've got this pre-market session. And then, more importantly for our chat today, after it closes, there's the after-hours session, which can go all the way to 8 p.m. Eastern Time. This is your shot to react to news that breaks when pretty much everyone else has gone home.
But hold on a second. If the big exchanges like the New York Stock Exchange and the NASDAQ are closed for the night, who's running the show? The answer is some pretty cool technology that does all the work behind the scenes.
It's all possible thanks to something called an electronic communication network, or an ECN. You know what? The easiest way to think about it is like a high-speed, fully automated dating service, but for stocks. Its only job is to find a buyer and a seller who want the same thing at the same price and match them up.
So how does this digital matchmaker work its magic? It's really just a simple three-step dance. You place your order to buy or sell. The ECN then scans its entire network at lightning speed, looking for the other side of your trade. And if it finds a match, boom, the trade happens instantly. No waiting, no middlemen, just pure tech making it happen.
Now, that all sounds super efficient, right? And it is. But here's the catch. This is where things get really interesting. The after-hours market is a totally different beast. It's kind of like a bustling city that turns into a quiet, almost empty town after dark.
And to understand why it's so quiet, we have to talk about something called trading volume. It's basically just a measure of how busy the market is. A high volume is like a packed stadium on game day. Tons of buyers, tons of sellers, a ton of action. Low volume? Well, that's more like a couple of people playing chess in an empty park. See, during regular hours, you've got millions of people in the game, from retail investors to giant hedge funds. The trading volume is huge. But after hours, that crowd thins out, a lot. You're usually dealing with a much smaller group of people. And often, they're the heavy hitters, the big institutional investors with way more sophisticated tools. And that's exactly where the risk starts to creep in. With so few people trading, prices can get, well, a little wild. The experts at Investopedia put it perfectly. They say a stock's price can shoot up after hours on some news, only to come crashing right back down the next morning when the rest of the market wakes up and has their say.
And this brings us to the most direct and, potentially the most costly consequence of this quiet marketplace. It's this wider gap between what buyers are willing to pay and what sellers are actually asking for. This is what's known as the bid-ask spread. Think of it like you're haggling at a flea market. The bid is the highest price a buyer is offering, the ask is the lowest price a seller is willing to take, and that little space between those two numbers, that's the spread. And that's where the danger is hiding.
So just to lock it in, right? The bid is what buyers are willing to pay. The ask is what sellers are willing to accept. It's that gap in the middle that we are really zeroing in on right now.
Okay, so during a normal trading day, with millions of people all competing, this gap is usually tiny. You might see a bid at $100.05 and an ask at $100.06. The spread is just one single penny. The market's a well-oiled machine. It's super efficient.
But after hours, that tiny little gap can turn into a giant canyon. All of a sudden, the best offer to buy, the bid, is $99.80, and the lowest offer to sell, the ask, is $100.30. That's a 50-cent spread. So what does that actually mean for you? It means if you're buying, you're probably overpaying, and if you're selling, you're leaving money on the table. It's a hidden cost that can eat right into any potential profits.
So when we put all these pieces together, what's the bottom line? Well, it really is a classic case of risk versus reward. Before you even think about jumping into after-hours trading, you've got to keep these key risks in mind. First, lower liquidity, which just means it can be harder to find a buyer or seller. Second, those wider spreads we just talked about, which means you could get a worse price. Third, higher volatility. Prices can swing like crazy. And finally, remember the competition. You're going up against the pros.
At the end of the day, after-hours trading gives you this really tempting chance to get ahead of the market. But with all these risks we've laid out, you really have to ask yourself, is that potential reward truly worth the gamble? And that's a question every single investor has to answer for themselves. Thanks so much for joining me.